The America First tariff policies implemented by President Trump post-April 2nd have caused unprecedented volatility across markets, and the aftershocks are reverberating in alternative investments as well. Firstly, with valuations facing pressure and investor sentiments turning more cautious, the expected revival in IPO monetization and exit activities by GPs that was underpinned by a positive view on the equity markets needs to be moderated. LPs should expect another year of muted distributions in 2025. However, the corrections witnessed can benefit activities in the private equity secondary space. The effects will not be immediate, but should market stress persists, secondaries activities would pick on the back of wider discounts on valuations, and the denominator effect, where falling public markets led to overallocation to alternatives and private investments in large institutional portfolios, albeit to a small degree compared to 2022. Amidst the volatility, hedge funds have again proven their value as shock absorbers and a source of uncorrelated returns. Just as we noted at the onset of the 2025, with volatile market conditions and macro risks expected for the year, hedge funds should deliver alpha relative to public markets, but with a wider dispersion in performance, which we are starting to see. Uncorrelated macro discretionary hedge funds led the performance with absolute positive returns in March, and we can expect the hedged returns to be important if market actions remain highly unpredictable. The recent turmoil is shifting market dynamics in favor of lenders in the credit markets, to the benefit of credit investors. However, private credit managers may have to contend with reduced deal flow as the tariff-induced uncertainty weigh on corporate financing activity and demand. Performance would be determined by how managers and existing portfolios navigate the crosshairs of lower volume, better terms for lenders such as higher spreads and increasing credit stress, as the second-order impact of tariffs work its way through corporate earnings and overall GDP. In short, alternatives won't be fully immune if the US or the global economy slides into recession. But alternatives and private markets offer insulation from the short-term swings and non-fundamental misalignments that define public markets during periods of event-driven stress. Dislocations also often create attractive repricing, improved terms and less crowded entry points, benefiting investors with dry powder and specialist expertise. Secondaries, opportunistic strategies, and macro discretionary and relative value hedge funds are areas where volatility-led dislocations can create attractive risk-reward amidst the current environment.
While there are still uncertainties ahead, leaning into more complexities and private markets have historically been beneficial during volatile times like this, supported by disciplined underwriting and a strong focus on manager quality. For forward-looking investors, this is the time to act. To back high-quality managers, rebalance your bets, and position your portfolio for the growth ahead.